Welcome back, everyone. We're here with our friends from Foster Financial. Today, we're here with Heather Foster talking about the current market news. But first, Heather, welcome to our new set. It's like we did it just for you. I know this is your vibe.
This is completely. If you guys ever, if you watch the video about our office, we're pretty much white, everything in black. And yes, so thank you for
Modern
that.
cookies on the table, welcoming energy, right?
Yes, definitely. We want to welcome people. We want to make them calm, especially calm in an environment like that we're in right now with the markets, with the debt ceiling, you know, with banks having issues. There's just a lot right now going on that I think is really making people go, is this different than anything in the past? Have we really ever been through anything like this before? And of course the answer is we've been through things like this before. In fact, with the banking side of things, I mean, we've been through a lot worse, through the financial crisis of '08. That's not what we're not dealing with credit issues with the banks. Instead, we're dealing with really interest rate sensitivity issues with the banks. And smaller banks, you're probably going to see that continue as far as seeing banks fail. And really what it has to come down to is when they have to keep cash reserves in their accounts, they were buying in order to get yield. They were buying long-term treasuries, long-term debt obligations that were paying very low interest. And as the feds were raising interest rates, the short-term rates went up, and so the banks are saying, hey, in order to give our customers a CD, let's say, a 9-month CD for 4.5%, because that's where the rates are, they're only earning, maybe 0.05 on debt obligations that they have purchased with the cash reserve side, but they're having to pay customers 4.5%. That yield, that is a very big loss, and so you're seeing that side of it is what is actually happening with the banks is it's not that they didn't have enough cash reserves, it's that if they have to sell those debt obligations that are paying 0.5% in order to free up cash flow as clients are taking money out, they're having to sell them at a great discount or a loss. So the banking thing is something to watch. Smaller banks are kind of where the concern is, because larger banks, a lot of them didn't stay in long-term or mid-term bonds. They moved towards short-term bonds last year, as we did with the investment side. But it's something to definitely keep an eye on. The FDIC $250,000 is something for people to watch. The other thing is big news is the debt ceiling.
Yes, I was just going to mention that.
All over the news. Are they going to get a deal? Well, they always end up getting a deal. A lot of times it's a lot of smoke and no fire. They usually end up passing something at the very last minute. But I think the bigger issue to look at and think about is, if they made a deal, let's say they didn't make a deal, what's going to happen? Well, there's $1.5 trillion of debt shortage this year. So if they don't cut a deal, we've got a shortage. How does that shortage get paid out? Do you know?
I'm guessing like inflation, though, like more like mortgage rates or just grocery store prices, or just
what they actually do is if they default and they can't get the ceiling raised, basically they're going to default on things like paying people either in their bond side of things. So if you own a treasury bond, you own a bond through the government, they may default on that bond payment because they don't have it to give. Or they also tend to look at entitlement programs like Medicare, Medicaid, and Social Security systems.
Does it affect your 401k at all, or?
The market side of it would, right? But this is more about the government and their obligations to pay debt. And if they don't raise the debt ceiling and don't cut a deal, then it's going to default on someone or something. And they have to say, where is that going to come from? So we're 95% sure they'll cut a deal. They always do. However, it's more the long-term trajectory that we as consumers need to be concerned about, because you can't just keep kicking the can down the road. Eventually, someone has to start paying for this. And again, the two ways that typically this gets paid for is, one, they cut entitlement programs. They cut things like Social Security. They cut things like Medicare. They cut things like, aid to the general person.
Those needed services.
Right. Or two, they raise taxes. It's one of the two that you'll see happen. Eventually, they're going to have to get this under control. They can control some of the spending, but the spending has been tenfold over the last 10 years is what they're spending. So they have to find a way to control it. And again, we always talk about taxes here. And I also always talk about legislation risk. I mean, legislative risk is a real risk. People look at the stock market and go, okay, we know that there's risk in the stock market. If you own a company and that company doesn't do well, it can go down. You also have to think about the legislative risk that we're dealing with. Monetary policy changes and policy changes in general can change someone from saying, hey, my Social Security is not taxable, to all of a sudden all of your Social Security is taxable. Or maybe because you did save $1 million in your 401k, good job, you were a great saver, hey, they're going to penalize you by causing you more taxes on it now, or taking away an entitlement program for you because you have too much money. So you have to be very, very detailed. You have to have a financial plan. You've got to lay out financial plans for stuff like this. Taxes, and entitlement programs, key indicators on something like the debt ceiling.
And that's why it's truly important, you know, get those questions answered. Stop by Foster Financial, right? You guys take a look at your screen right now. You guys check them out. A lot of information here, giving us updated on those current market news. Thank you, Heather, for being here. You guys check out Foster Financial. We'll be right back.